Warren Buffett is widely considered one of the greatest investors of all time, with a staggering net worth of $80 billion. If you're a fan of the channel, then you know I like to learn from the experience of Buffett and his partner in crime, Charlie Munger. Much of their success comes from investing in companies with sustainable competitive advantages and holding them long term. Although his company, Berkshire Hathaway, chooses not to pay a dividend, a significant number of their holdings do. In fact, his investments are generating more than $4 billion a year in dividend income. Throughout this video, I'm going to explain how Buffett's massive cash flow lets him consistently double his money on many stocks. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Today, I want to show you how Warren Buffett's long-term investing strategy generates significant dividend income with huge yields on cost. Warren Buffett is what's known as a value investor. This investment strategy involves picking stocks that are trading for less than their intrinsic or book value. However, his strategy evolved over time with a great deal of influence from Charlie Munger.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, say, in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money.
This transition to focusing on the quality of the underlying business was learned through their investment in See's Candy.
But we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism constructively is well, think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying See's, you can say that Berkshire's been built partly by learning from criticism.
Now I'll tell you exactly why walking away from See's Candy would have been a terrible idea. In 1972, they bought the entire company for $25 million. That year, the business had $31 million in sales and made $2.083 million in profits after taxes. Additionally, the business needed a working capital of $8 million to operate. Based on Buffett's valuation of See's, he was unwilling to pay more than the $25 million he offered. As of 2007, See's Candy has earned Berkshire Hathaway $1.35 billion in pre-tax earnings. That year, See's sales were $383 million, netting over $82 million in pre-tax profit. So Buffett is well over tripling his initial investment in See's Candy every single year. Based on this, it was totally irrelevant whether he paid $100,000, $1 million, or heck even $10 million more. In 2019, Buffett said that See's has produced well north of $2 billion in pre-tax earnings, and the chocolate company remains a cash cow for Berkshire Hathaway. See's Candy exemplifies what Buffett looks for in a business. The company has built a competitive advantage through significant brand and customer loyalty. Buffett has said, long-term competitive advantage in a stable industry is what we seek in a business. If that comes with rapid organic growth, great. But even without organic growth, such a business is still rewarding. We will simply take the lush earnings of the business and use them to buy similar businesses elsewhere. This is exactly what he did with See's Candy.
See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire.
The company had limited potential for scaling, but was able to provide a reliable cash flow. This mindset of buying great businesses at fair prices would bleed into all of Buffett's future investments. Warren Buffett does not specifically target dividend stocks, yet the majority of his holdings pay dividends. This correlation comes from the types of businesses he targets. Dividend stocks are often highly profitable and mature companies with proven business models. This overlaps heavily with Buffett's investment preferences. As I mentioned at the beginning of the video, Warren Buffett's Berkshire Hathaway earns around $4 billion in annual dividends. This number doesn't even include returns from companies where they have full ownership, like See's Candy. One of Buffett's best performing stocks is the Coca Cola company, which he's owned since 1988. This year, that investment will pay him more than $656 million in dividend income. With an initial cost basis of $3.24 per share, Buffett now boasts a 50.5% dividend yield on cost. This means that he will be more than doubling his initial investment every 2 years through dividends alone. Coca Cola has been consistently growing their dividend for over 58 years, and there seems to be no indication that this will stop anytime soon. This is a classic example of investing in a company with strong competitive advantages and holding long term. If you want to learn more about Coca Cola, I did a full stock review on the company and will provide a link in the description of this video. In 2016, Warren Buffett invested heavily into Apple, and Berkshire Hathaway now owns over 5.9% of the company. He's already seen a significant return on investment, but I think it's poised to be his next Coca-Cola. This year, he's set to earn $822 million in dividends, which is the most of all his holdings. I don't know his exact cost basis, but given the time he invested, I assume the yield on cost is currently around 2 to 2.5%. Apple is currently the most valuable brand in the world and has massive customer loyalty. Additionally, it has 9 years of dividend growth and a 10.5% 5-year compound annual growth rate. I would not be surprised at all if in 30 years Buffett would be doubling his initial investment every 2 years through dividends, similar to Coca-Cola. If you want to learn more about Apple, I also did a stock review on that company and will provide a link in the description as well. Buffett has many other dividend stocks with a huge yield on cost. This is accomplished through the long-term nature of his investments. Moody's, the credit rating, risk assessment, and data analytics company, is another cash cow for Berkshire Hathaway. This year, it will pay over $55 million in dividend income. With an initial cost basis of only $10.05 a share, Berkshire's annual yield on cost is 22.3%. Buffett doubles his initial investment through dividends every 4.5 years. Considering the current price of Moody's is around $270 with a 0.8% dividend yield, his investment is a prime example of how long-term investing can net massive yield on cost. American Express is another one of Buffett's holdings, which pays $260 million in annual dividend income. At an initial cost basis of $8.49 per share, Berkshire Hathaway has a 20.3% dividend yield on cost. This means that in just under 5 years, they will double their initial investment through dividends alone. Other notable investments, such as Bank of America, pays $743.7 million in annual dividends. Wells Fargo pays $659.3 million. Kraft Heinz pays $521 million. U.S. Bank Corp pays $222.5 million. And J.P. Morgan Chase pays $214.2 million. These are just some of the many dividend stocks in Warren Buffett's portfolio. The The main takeaway here is that when you invest in companies with sustainable competitive advantages over a long time horizon, you can receive huge yields on cost and massive returns. I hope this video provides some interesting ideas to think about, and let me know in the comments if you like this topic. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. You can support the channel on Patreon and be a part of making these videos happen. The link is in the description. Please leave a comment below, and thank you for watching.